On Friday, Mike A brought to us an issue, and he was regarding BBBY, Bed Bath and Beyond. He says, I've lost big money, I am lost. But I am wondering what kind of play could have made that kid $100 million today on BBBY. There's several articles about a 20-year-old student and a 20-year-old kid who made $100 million. Mike A asked, please explain on your webinar. I'm sure that will be very informative for the traders. Well, we covered it on Friday, but we got some more information over the weekend. Let's share that with you. But what happened with BBBY? This is one of the Reddit stocks, the Wall Street bets, of course. Gentleman Cohen was talking about a large share that he had on the position, a few million shares of stock. Essentially, during the week, he sold off about $58 million worth of shares. The stock naturally plummeted. Now, there were some rumors that Cohen also had a fair amount of out-of-the-money calls that were purchased, maybe October, November, 60 or 70 strike, way out of the money. It might have only cost him 5 cents or something. It may have doubled his value, but I could not find the articles. That might have been rumor only. Now, is it possible that he bought puts before he unloaded at a bear put debit spreads? We don't know. We'll have to find out later because I'm sure this will be looked into. Speaking of which, Mike's question really referred to something else. In the age of instant news, clickbait, and to try to get the first headlines out there, the headlines were deceiving. Student makes $110 million by betting on a meme. 20-year-old student, investor made $110 million from trading Bed Bath & Beyond. Student 20 makes $110 million trading meme stocks. Well, it was true, but it's a little bit more complex than something I think Mike was referring to. This was not any type of elaborate options trade where a 20-year-old college student or 20-year-old student put $1,000, $1,500, $2,000 into options and made $100 million. Jake Freeman is a 20-year-old college student who essentially purchased 4.7 million shares of Bed Bath & Beyond in July at about $5.20 per share with his uncle, Scott Freeman, from the Freeman Capital Management Group. This gave the Freeman Capital Management Group 6.2% passive stake in Bed Bath & Beyond. It was probably purchased sometime early July or mid-July when it was around $5, $6 per share, $5.20 as it's mentioned. And a few weeks later, going along with some of the short squeeze talk on the Wall Street bets and the Reddit community, sometimes known as the apes, Bed Bath & Beyond rocketed above $28 per share. Around that same day on Tuesday, Freeman Capital exited its entire stake of 4.7 million shares of the stock. That was the $110 million in profit. On the same day, the Cohen gentleman, however, also filed with the SEC saying he intended to sell as many as 9.5 million shares or close to it, beginning that day as well. So essentially, we're looking at almost 15 million shares being sold on Tuesday and Wednesday, which naturally created the pressure on the stock to decline drastically. Now, this information I saw from an article on Saturday, the day after our presentation on 820 by AJ Fabino, Meet the 20-Year-Old Who Made More on BBBY stock. It wasn't just some kid playing with options. He works with or works for the Freeman Capital Management Group, and they went in at 4.7 million shares. So it was just a stock holding position on a meme stock that rocketed, and they exited at almost the right time, near the high of about 28.60. Now, I'm a little bit more conservative. I have missed profits, and I know it, but I've also missed losses. Even though I'm a little bit youngish, I tend to avoid the meme stocks a lot. To me, it's like a lottery ticket. If I played it, it'd be less than 1% of my total portfolio, whether buying shares or entering into a spread or just buying options on those positions. When the market started to recover after March 20th, 26th, 2020, going into April and June and July, as the recovery took place, we started going back into bull put credit spreads. But when I ran the search and power options for my preferred bull put credit spreads, if I saw some of the meme stocks such as Peloton, Zoom, Hood, Robinhood, GameStop even, Best Buy, Bed Bath & Beyond, I would just move on to the next trade listed on that search result, rather than take the chance of going into a position where it could drastically affect my outcome from uncertainty, from a short squeeze, or anything that was going on. Now, I know millionaires were made. I know some millionaires were also broken. Don't get into these type of stocks with large swings without proper position sizing. Only invest what you're willing to risk, knowing that there's a chance you might see a 70 or 80% drop on the stock shares, or especially on an options play, which might go quickly to a 90 or 100% loss. Always consider a proper hedge or protection in place for not only buying shares of these swift-moving meme stocks, but also for option strategies. Yes, proper protection or hedge will be expensive for those positions, but it's worth it to control risk to only maybe smaller percentages of 15 or 20% as opposed to seeing a 60 or 70% decline with the wild swings. Have an exit strategy of what percent you're willing to risk in place and adhere to it. If it goes beyond your projected stop of 10% loss or 15% loss on the stock, or maybe 30 or 50% on an option strategy, don't hold and hope when things go bad. Now, maybe, yes, if you've got a 90% loss on a stock share, you just figure, okay, if it's got to come back, hopefully it comes back, but it might not ever. Not worth it maybe to take the 90% loss, but is it worth it to just continue to hold it, hoping that you get less of a loss? Maybe. But when it starts going against you, adhere to your exit plan, and if it goes slightly beyond that, don't hold and hope, because you can risk taking a lot more losses than you are willing to take initially. Now, speaking of apes, in a similar format of trying to get clickbait and trying to get investors to click on the hot topic, this morning we saw many articles being posted that said AMC craters 43% in the open, AMC craters 45% in pre-market trading. Well, AMC did drop from its price on Friday around $18 to around $11 or so. But this was the effect of essentially a 2-to-1 stock split with the release of APE, AMC's preferred stock shares. Meaning that if you had 100 shares of AMC at $18 on Friday, in a true 2-to-1 stock split, this morning you would have 200 shares of AMC at $9. What you had post-split, or pre-split, excuse me, would be the same monetary you had at the moment of the post-split. Now, this one is a little bit different. If you had 100 shares of AMC at $18 on Friday, this morning you would have had 100 shares of AMC at about $11.35, and also 100 shares of the new AMC preferred stock, APE, around $7.40 per share. It was actually a little bit higher. You're in a profit of about $18.75 combined at 12 noon Eastern time, not a loss of 40% on the 100 shares of AMC that you owned before Friday. Now, if you're in power options, you own shares of AMC, just use the edit function from the more information button in the portfolio to adjust the AMC cost basis, then add the new shares of APE in as well. Now, another thing that you might want to consider when looking at AMC or APE, over the weekend, AMC's competitor Cineworld, which runs Regal Cinemas, mentioned it might consider a bankruptcy filing. I don't see anything about AMC's valuations of what they're looking to do or where their financials are, but a competitor in the industry mentioning bankruptcy might want to have a hesitation of doing either one of these two positions. Do your research and analysis, your due diligence. Now, disclaimer, this is not a recommendation to buy, short, invest, or trade meme stocks of any kind. Investing in volatile securities directly with shares or with options is high risk. Yes, there's a potential for the high return, but as mentioned, practice proper position sizing. Don't risk any more than a small portion of your portfolio with these volatile positions. Look for a proper hedge or protection, even though it might be expensive, to keep yourself out of trouble and away from the wild swings that occur. Have an exit strategy in place of what percentage you're willing to lose on the stock position or on an options play as well, and stick to it. And if it goes beyond that, don't hold and hope if things are getting out of control. Control your losses as best you can. Move on maybe to something else and look to make it back on a better position, more suited for the option strategies you're using or a general consistent market direction.